Well, howdy there folks, and welcome into today's video. First off, hope you guys are doing great out there as always. Here today in this video, we're going to get into the public account. I'm going to review this portfolio. I'm going to say, is this a bad portfolio, good portfolio? Do I like it? Do I not like it? What stocks do we need to buy? What stocks do we need to sell? We're going to look at this really in depth here today, which, this portfolio, man, I haven't been giving it as much attention or love recently, to be completely honest. My attention's really been focused on the main private account I have, and I haven't paid this one as much attention. So I figured let's review this as just like a channel. Let's all take a look at this. I think there would be a lot to learn from a video like this about kind of like how I look over a portfolio. What do I think is good about the portfolio, bad about the portfolio, troubling about the portfolio, those sorts of things. I think this can be a great video for learning, as well as we're going to talk about a bunch of different stocks in this video and kind of get my perspective if these are good stocks, bad stocks, why I'm excited about these stocks or not so excited about these stocks. So hope you guys enjoyed. As always, all I ask in return is that you smash that like button. That's literally it, okay? Alrighty guys, let's get into this. All right, so right off the bat here, I like to look at position sizing. So I ranked everything here in the public account. I ranked it by position sizing. So right off the bat here, $530,000 in Tesla Maesla, right? That's a really, really large amount out of a $1.66 million portfolio. But I think it's very important whenever you're looking over this, as far as like how big a position size is, how much did you put into it? I think that's very, very key. How much did you put in? Did you put in 500,000 and that that it's that big of a position because you put 500K in, or not, right? This is a position we put 34,000 in. So it became a huge position in the portfolio because it went up so much, right? So I would be more concerned if I had put in that much into this portfolio, because that would be a lot to put into one position out of a $1.66 million account, right? But because it is essentially 34,000, that is not a big chunk out of this. So I feel comfortable holding that amount. If Tesla ever was, let's say hypothetically, to go over 50% of the portfolio, that would be a range in which I would likely have to, especially if I saw other good deals out there, deploy the money elsewhere, right? Doesn't mean sell off the position completely, but it means just bring down the position sizing some, sell off some shares, deployed into other stocks. But as of right now, I feel comfortable with that amount essentially. It's a little less than 1/3 of the portfolio is in Tesla stock. But once again, it's because it went up so dang much, okay? Now, real quick here, I want to dive into, before we start going through Tattooed Chef, Dropbox, some of these others. First off, I like to kind of look at, like, what type of stocks are we in? So one's an EV play / energy play, right? One's a super high growth food company. We have a cloud company, e-signing of documents. We have an online retailer, e-commerce player. We have a gaming and streaming company. We have a social media giant / advertising company / a lot of things, right? When you're in big tech, you're going to be a lot of different things, and that's Facebook. We have a 5G play, semiconductor play. We have a, let's call it a Jack Jackson play, right? Superstores in the MJ space. We have a pharmacy, retailer. We have Upwork, which is, I would call it freelance economy, right? Hiring, those sorts of things. Avant Brands, which is a spec stock, Jack Jackson play. We have a cosmetics beauty company, and then we have another semiconductor company. So if I look at just the positions, definitely very, very diversified here across a lot of different industries, not like we're all just in one sector or something like that. Very, very important, okay? Now, the chef, Tattooed Chef, is the second biggest position. 186,000 put in this position. Right now it's worth 207,000, up $21,000 on Tattooed Chef so far. So when I look at that position, comfortable with what I've put into that so far. I could build this position a little bigger. Obviously, this is my highest conviction play for the long term right now, which means essentially I'm allowed to continue to buy this stock. I could see myself owning maybe even $300,000 worth in this account. And that's $300,000 put in. I want to be really clear about that. So if the stock was to go up a bunch or down a bunch, like I could see myself getting up to a range where I actually have $300,000 in Tattooed Chef stock. When I look at it, it's super high growth. That's very exciting, right? But it's a food company. It's a food company, so I definitely feel safer in a stock like that versus some other industries where one bad thing and your whole business is thrown off, right? Food companies, drink companies, as long as you execute keep growing the SKUs, keep innovating, keep getting in more spots, continue to build your brand. I love Tattooed Chef, okay? Dropbox. If I look at Dropbox here, this stock is really roared. Dropbox is an interesting one. So when I was buying that, definitely got some pushback from folks. Oh, Dropbox, that stock hasn't done anything. The past is a past. Everybody watching this video, the past is a past in regards to stock. What a stock price has done in the past, whether it's gone up a bunch, down a bunch, it's completely 100% irrelevant if you are a true fundamental investor. Whatever the daily chart says or the 3-month chart, as a fundamental investor, it means absolutely nothing. If you are a trader of some kind, that's fair play at that point. But for somebody like myself, it doesn't matter, okay? All I cared when I was starting to buy this stock, what was that, winter time, roughly, right, of 2020 into the beginning part of 2021, I looked at this company and said, it's a significantly undervalued asset that I think is going to grow, quite a bit in the future, right? And so far, that hypothesis is obviously playing out. We're already up 66% on this, already up 64,000, and that's a stock I feel extremely safe in, being one of the biggest positions, the third biggest position in the portfolio. I feel extremely safe in that stock. That is not a stock that I feel is going to get cut in half tomorrow. Everything's possible in the stock market. It doesn't come with those type of risks. They have almost no customer concentration. They have a needs-based business model. They're what the products they have, e-signing of documents, cloud storage, these are needs-based things. And they have pricing leverage over the long term as well, right? Because we see all the cloud providers starting to get to that level where it's starting to become more of a focus around cloud. It used to be a market share game. Market share games in the past now. Now it's a profit game. And so somebody like Dropbox is going to continue to thrive, in my personal opinion, okay? Revolve. So this is an interesting one, right? Really large position for being an e-com company, and specifically being a more niche e-com company. It's not like if Revolve is Amazon, they're selling, average ticket price is around $300 for them. They're selling nice dresses and shoes and those sorts of things, and their clientele base is very, very heavy with women, and the stock's doing amazing. And so it's not like we put a huge amount into this. We put $28,000 into it. It's worth $156,000 now. 457% gain on Revolve. Revolve, this was a company I looked at and I said, it was just a beaten down dog. It was a beaten down dog that I thought had huge growth going in future years. And you'll find that with a lot of stocks of mine. I like to find beaten down dog stocks that I think have huge growth potential in future years, and they're just kind of forgotten about. It happens all the time by Wall Street. They'll just completely forget about these stocks. Dropbox and Revolve are perfect examples of that, and you see the way these ones are playing out. It's absolutely amazing, right? And Revolve with the huge 157% move, 457% move there. It's just been an absolute beast for us. Very, very happy about Revolve overall. And I feel comfortable with it being my fourth biggest position, especially because I put in a very small amount of money into the stock, okay? Corsair Gaming. Now, here's where I have an issue. Why haven't I been buying the stock heavier in this account? I need to, flat out. No excuse. I need to be buying the stock heavier ASAP in this particular portfolio. It's $27 and change. We're down 21% on this position. I need to add this stock and add it aggressively. If I keep waiting on this one, eventually Corsair is going to move, in my opinion. I don't know whether it's tomorrow or next week or next month or next year, but I am 100% confident that Corsair will move. And when it starts moving, it's going to start moving fast. And no one knows exactly when it's going to happen. But at the end of the day, when I look at this one, we're down 21%. I could easily make this position a lot bigger, and I need to make it a lot bigger. I feel like the downside risk in Corsair is extremely low. The risk is it could always go to $25, $24. But I don't see a very realistic scenario where it goes under that. And I see an extremely high probability the stock's 2x's or more over the next 3 to 5 years. So when you take that into account, I need to get on my horse and start buying some more dang Corsair, okay? This is a mistake by me not to add the stock more aggressively. I think I added a little too aggressively at first. My cost base is $35.50, and the problem is now I'm not adding aggressively enough in the public account. I need to get back to adding the stock and building that position bigger and bigger. I need to get up to maybe 7,000 shares in this portfolio, and I need to do it fast. So, mistake by me, added a little too aggressively off the bat and haven't been adding aggressively enough right now, okay? Facebook. So, The FB, you know, this one I should have built bigger. Another, I would call it mistake by me. I didn't build this one quite big enough. I put $56,000 into it. I should have put between $75,000 and $125,000 into the stock. Extremely safe play for me. Not going anywhere but up over the next 5 years, in my opinion. 134% gain on us so far. $76,000 of gain so far in Facebook for this portfolio. If you think about how diversified that business model is, I should have just added more. Feel very comfortable what I have in the stock. Not really looking to add to this position really at all. And by the way, I'm going to let you know about a stock I do want to add in the public account as well. But yeah, Facebook, man, you know, I really should have built this one bigger. Let's put it that way. Skyworks Solutions, huge 5G play. Look at the teardowns of the iPhones. Look at the next teardowns of the iPhones, the ones that are going to be coming out in September. And you're going to see a whole bunch of Skyworks Solutions 5G chips in it. I feel very comfortable with position sizing here. It's, what would this be, our seventh biggest position? Let's see, 1, 2, 3, 4, 5, 6, seventh biggest position here. We put 49,000 into it. It's worth 120,000 now. 144% gain on this one, $70,000. When it comes to Skyworks Solutions, it's just a beast. You know, usually, you know, sometimes you're going to have trust issues with semiconductor companies because, you know, let's say Skyworks Solutions, for instance, usually they get 40% plus of their revenues from Apple, right? That comes with the risks. Like, what if their relationship with Apple broke up or something like that? But when it comes to a stock like Skyworks Solutions, this company is so well run. The management team for this company is absolutely amazing when it comes to Skyworks Solutions. They're always building this company stronger and stronger and stronger. And it's an interesting business model because they can go through some huge kind of spikes in demand for new chips, new chipsets, their products, all those sorts of things. And then all of a sudden they'll be making great progress on the next chip designs, but a lot of times their business can flatline or even go down for a period of time. Right now, let's be very clear, Skyworks is like in a business model like this. Eventually, they're going to kind of flatline or even trend down for a little bit while they're making their next chip designs. And that might be a time period in which I cash out of Skyworks Solutions or at least cash some of the position, especially if I see a better opportunity for me out there. But for now, this company has several years of this going for it, essentially. So I'm not interested in selling out of that one at all. I just want to see the revenues and profits continue to build there, okay? Planet 13, so this one we're doing really well on, 53,000. You know, I made a mistake on this one, okay? I kept buying heavy in all my other accounts, Planet 13, as the stock was rising and rising and actually averaging up. It's really easy for me to average down on a position, just like psychologically, most people have trouble averaging down on a position because they begin to feel unconfident and they think they made a mistake because the stock's going down in the short term and things like that. For me, it's the reverse. For me, I have a lot of trouble averaging up on a position. I love to average down. It's actually really easy for me, but averaging up's tough, okay? And so I continue to add Planet as it went up to $2, $3, $4, and even $5. But when it came to this account, I never averaged up. Maybe I fell in love too much with that $1.25 cost basis. I don't know. All I know is I should have added that position more aggressively. It would be a six-figure plus position if I just added more aggressively when it came to the Planet there. I should have done it, man. I went too baby soft, you know, overall in this one, okay? But I feel very, very comfortable with current position sizing. If this one goes under 5, which, you know, doesn't have a huge likelihood of going under 5 just because there's so much demand for this stock out there. But if it was to go under 5, I would have to say bye-bye to that $1.25 cost basis and just add some more dang shares in this portfolio. I love the stock for the long term, so does it matter if the average cost is $2, $3? You know, for me, it really doesn't. I need to add more shares there. WBA. So this is one that's really, really interesting, okay? The only reason I feel comfortable with only having, let's say, $44,000 in this stock, in this particular account, is because I bought 7 figures in my main private account of this stock. Extremely aggressive ad, let's put it that way. So in the public account, I'm really kind of taking into account like what I have in the other accounts, and I'm like, I have such a crazy big position having 7 figures in other portfolios that I'm like, I'm good with just having 44,000. If I wasn't for the fact that I had such a massive position in the private account, my main private account, I would build this position into a top 5 position. I'll be, you know, just be flat out honest. But because I built it so big in the other ones, I don't want to get too over, I guess you can say, overinvest it into WBA, right? I like WBA a lot over the coming years, but at the same time, I like some stocks maybe even a little better than that, including the chef, right? So that's WBA. Upwork, if we look at the Upwork position here, $36,000 is current value on this. We put 11,000 in, up 229%. You know what? I should have built this position bigger. This is one I regret, okay? This is one I regret not building heavy enough. I saw the opportunity there, with such a huge runway of growth for, the next decade plus for this company. There are two main players in this market that at least I look at over the next 5-10 years. It's Upwork and it's Fiverr. And those companies have tremendous opportunity in front of themselves in terms of building out their businesses in so many different verticals. And there's so many different ways Upwork can make money. It's not just like one deal and you're done. There's so many different ways they can convert and make money overall in this business model today, never mind where the business is going to be on 3 or 5 years from now. And so I regret not buying more when the stock was 13 and some change. I kind of entered in with a baby position. And the thing is, like, when you really see crazy pricing on certain stocks, you got to be ready to add aggressively, just flat out. If a stock's flying high and it's at a new 52-week high and 52-week high, that's sometimes when you need to kind of take a breather and be like, maybe I'll chill a little bit. But that was not the case with Upwork. That was not the case at all. That was a beaten down dog, and I saw definitely a future where the stock got back to $30, $40 a share, and it's done even better than that, right? Avant Brands. So Avant Brands, like a Corsair, I need to add more shares. I need to get up to 88,000 shares, maybe even 99,000 shares, something like that, of the stock, maybe 99,999 shares. That might be a cool amount. I got a little bit of FOMO in this one. I really did. Got a little bit of FOMO when it came to Avant Brands. I built the position a little too quickly, and obviously I'm paying the price for building that position too quickly. And now I need to build the position bigger. So it's my spec stock. So I can't build this super heavy. There's no other stock in my portfolio that I would consider a spec stock, right? The Planet, I no longer consider that a spec stock. They got 3 different locations open now. Great growth, building, the cash balance is up to 9 figures plus. And so the Planet used to be a spec stock. I don't consider it a spec stock anymore. But absolutely, Avant Brands is a spec stock. So I can't make it too big of a position. But could I add another 10,000, 20,000 shares of stock? Absolutely. And I need to do that. So if I'm looking at 2 positions, I need to add ASAP. It's Avant Brands and it's Corsair Gaming. I need to build those 2 positions ASAP, okay? Corsair Gaming obviously doesn't have the upside that an Avant Brands has, but at the same time, I feel far safer in a Corsair Gaming versus Avant Brands, right? Those smaller cap companies definitely come with risks, as we all know. Elf Cosmetics, and by the way, I still got to tell you guys about stock I'm thinking about buying in this portfolio, okay? Elf Cosmetics up 312% on this one, up $22,000. It's done phenomenal for us. $7.28 cost basis. It was a different type of company when I was buying this one, and it was a stock in which I think, okay, so let's be honest. My audience is like 85 to 90% male, right? Probably closer to 90% males. And so a lot of the folks that follow me were like, what? A cosmetics company, a beauty company? Like, they didn't get it. And the stock had been doing horrible. And I looked at the stock and I saw a tremendous opportunity. I saw what was going on in YouTube with Elf getting a ton more products out there to big YouTubers, such as back then it was like Jeffree Star, that was huge, and some other makeup YouTubers. And they were getting tons of views on Elf products. And what the creators were saying was very, very positive. And so I was looking at this and I was like, this is a huge opportunity in my opinion. And so I took a controlled risk on the stock, and it did amazing for us, 312%. It's a $30 stock here today. Now, I took profits on the stock over time, and we made a lot of money on the stock, and I only have the 30K position left. Some of the profits you can say I took a little too early in the stock, especially around the $20 level, but I did deploy that into a lot of other stocks in this portfolio that have done tremendous, right? Some of the Elf money, I'm sure, ended up in Revolve, and Revolve's actually outperformed Elf over that amount of time, right? I'm sure some of that money ended up in Upwork, and Upwork, since that time, has outperformed Elf, right? And so, I could look at it from a perspective of I sold some shares too early, but a lot of times, like if I move the money into a stock, it's a better investment. For instance, there was a time period when I held Apple stock. And although I loved Apple stock, I sold the stock. And where did I put that money? I put that money into Tesla. And Apple's done great since then. Apple's been a moneymaker. But you know what did a whole lot better? Tesla. So that's a tough, positions you kind of get into sometimes. It's like, am I going to, sell this to buy this, things like that. And as long as you're super confident, you can make those decisions. Cruisy doozy. So Cruisy doozy is kind of in no man's land in this account, up 126%. They have some exciting chipsets coming, likely in the new iPhone, bigger dollar amounts and those sorts of things. But it's kind of no man's land. I'm like, do I want to sell this stock? Do I want to buy this stock? I don't really want to sell it because I do see new chipsets coming for them and new ASPs and money making opportunities for Cruisy Doozy. And that's exciting. But at the same time, I don't want to add the stock. So that's why I say I'm in no man's land when it comes to Cruisy Doozy right now, because it's a tough one. So account totals up 906,000, up 119%. That doesn't account for any dividends received in this account or any profits taken in this account, which both have been pretty immense over time. So when I look at the portfolio, I am mostly happy, but I am not 100% happy with this portfolio. I do not think it is a perfect portfolio by any stretch of the imagination. I do not think I have ran this portfolio perfect. And to be quite frank, there is no such thing as running a portfolio perfect. That's the way I always view it. There's no such thing as like, you're perfect. There's always some moves you could make that are a little better. There's always some positions that you maybe built a little too fast or a little too slow, and it's always about learning from those and adapting and just making yourself better and better, bigger and bigger beast over time, right? The stock, honestly, I need to add in this portfolio. I just started adding this one in my main private account, literally like a week ago or so, is Amazon. Amazon feels right in this portfolio. Another growth stock. That one would be a big tech, right? And it just feels like Amazon's needed in this portfolio. Not a massive position. I don't need to build that into a $250,000, $500,000 position in this portfolio. Literally just 50 to 100K. It feels like Amazon is needed in this portfolio overall, guys. But let me know if you like any of these stocks in the comment section. Let me know if you like the portfolio. If you don't like the portfolio, let me know what stock you think I should add in this portfolio next, and why do you think I should add that stock in this portfolio next. I would love to hear from you guys as always. If you're looking to learn everything that I possibly know about picking stocks, running portfolios, all those sorts of things, check out the pinned comment down there. That will be to join us in the private stock group, in the private Discord chat, and learn literally everything I have up here. Download it directly to your brain. If you haven't got a chance to check out the Hungry Bowl yet, make sure you do that. That's absolutely free to join that, and download that on your phone or iPad. We're on iOS, we're on Android. Track your stocks, track your cryptos, listen to earnings conference calls, maybe even SEC reports down the road, okay? Read our daily newsletter, keep up with news in regards to your stocks and things like that. Much love as always, guys, and have a great day.